Bitcoin's price movements often dictate the direction of the entire cryptocurrency market. When Bitcoin experiences a significant price drop, other cryptocurrencies, particularly altcoins, tend to follow suit. Understanding this market dynamic is key to navigating the crypto space, as it reveals the underlying structure and psychology at play. This analysis will break down the primary reasons why a decline in Bitcoin's value typically leads to a broader market downturn. Bitcoin is widely recognized as the benchmark for the entire cryptocurrency asset class. Its market capitalization and historical precedents give it a dominant position that influences investor sentiment and market trends. Consequently, when Bitcoin's price moves aggressively in either direction, altcoins tend to mirror that trajectory as traders and algorithms react to the market's primary indicator. This phenomenon is often referred to as Bitcoin dominance, a metric that measures Bitcoin's market cap relative to the total crypto market. A high dominance percentage indicates that Bitcoin holds significant sway over the valuation of other digital assets. Therefore, a major sell-off in Bitcoin sends a powerful signal that ripples across the entire ecosystem, pulling other cryptocurrencies down with it. Most capital entering and exiting the cryptocurrency market is routed through Bitcoin. Many altcoins are traded against Bitcoin in what are known as BTC trading pairs. This means that to buy or sell certain altcoins, investors often must first transact with Bitcoin. When a large-scale Bitcoin sell-off occurs, it effectively drains liquidity from the entire market. As investors convert their Bitcoin into stablecoins or fiat currency, the total amount of available capital within the crypto ecosystem shrinks. This reduction in liquidity leaves altcoins, which typically have thinner order books, more susceptible to sharp and rapid price declines. Sudden and steep drops in Bitcoin's price often trigger widespread fear, uncertainty, and doubt FUD among market participants. As the market's primary store of value and most trusted asset, a faltering Bitcoin price can erode confidence across the board. This psychological impact leads to panic selling as investors rush to exit their positions to avoid further losses. In this environment, risk aversion intensifies significantly. Investors tend to liquidate their holdings in riskier assets first, which in the crypto world are the altcoins. This flight to safety causes capital to flow out of more speculative projects and into more stable assets, amplifying the downward pressure on the altcoin market. In recent years, large institutions, including hedge funds, asset managers, and corporate treasuries, have become major players in the cryptocurrency market. Their activity is predominantly concentrated in Bitcoin, as it is the most liquid and established digital asset. The launch of spot Bitcoin ETFs has further solidified this trend, channeling significant institutional capital directly into Bitcoin. Because these institutions trade in very high volumes, their actions can create significant market waves. A decision by a few large entities to sell off their Bitcoin holdings can initiate a cascade of sell orders. This institutional selling pressure on Bitcoin quickly spills over into the broader market, as automated trading systems and retail investors react to the initial drop. Leveraged trading is a common practice in cryptocurrency markets. allowing traders to open positions that are larger than their initial capital. While this can amplify gains, it also dramatically increases risk. When Bitcoin's price falls sharply, it can trigger a wave of liquidations, where exchanges automatically close leveraged long positions to cover losses. These forced sell events create a domino effect. The initial liquidations add more selling pressure to the market, pushing the price down further and triggering even more liquidations. This cascade can spread from Bitcoin to altcoin markets, especially since many trading platforms use cross-collateralization, where a trader's entire portfolio can be used to back their leveraged positions. In periods of market stability or growth, different cryptocurrencies may exhibit unique price movements based on their specific fundamentals or narratives. However, during significant market downturns, the correlation between Bitcoin and altcoins tends to increase dramatically. The principle of diversification often breaks down in these conditions. When the market is bearish, overarching sentiment and macroeconomic factors tend to overshadow project-specific developments. As a result, most cryptocurrencies move in unison. Following Bitcoin's lead, investors sell assets indiscriminately in a risk-off environment, causing the entire market to fall together regardless of individual project strengths. Bitcoin and the broader cryptocurrency market are increasingly treated as risk-on assets by investors, similar to technology stocks. This means their prices are highly sensitive to global macroeconomic conditions. Factors such as rising interest rates, high inflation, geopolitical instability, or a weak economic outlook can lead investors to reduce their exposure to assets they perceive as high risk. Because Bitcoin is the primary gateway for institutional and retail investment in crypto, it is often the first asset to react to negative macroeconomic news. As investors de-risk their portfolios, they sell Bitcoin, which in turn triggers a sell-off across the entire crypto market. The interconnectedness of the ecosystem ensures that what affects Bitcoin will inevitably affect altcoins as well. Ultimately, the value and stability of the altcoin market are heavily dependent on the overall confidence in the cryptocurrency ecosystem, which is anchored by Bitcoin. Bitcoin serves as the foundational layer of trust for the entire asset class. Any event that weakens trust in Bitcoin invariably undermines the perceived legitimacy and future prospects of altcoins. Speculative capital is quick to abandon assets that lack a strong, established foundation when market sentiment turns negative. Since most altcoins are considered more speculative than Bitcoin, they are the first to suffer from a crisis of confidence. A decline in Bitcoin's price is often interpreted as a decline in the health of the entire crypto market, leading to a broader exodus from altcoin positions. Bitcoin's position as the market leader, its central role in liquidity flows, and its influence on investor psychology are the primary reasons it dictates the direction of the broader crypto market. Its dominance is further reinforced by institutional trading patterns, the mechanics of leveraged liquidations, and its sensitivity to macroeconomic trends. Until the market structure evolves to reduce this dependency, a significant drop in Bitcoin's price will almost certainly continue to pull the rest of the market down with it.